The Venezuela earthquake paradox: how India's crypto ban exposes the hidden fault line between disaster. The old approach just got more expensive. The practical edge now comes from changing process, timing, and tooling together. We will map trigger, incentive shift, and downstream impact before the close. Right now, the government is trying to access frozen sovereign funds for disaster relief. It can't. 8,000 miles away, India's central bank is moving to completely bar financial institutions from crypto exposure. These stories seem unrelated. They're not. They're the same story about what happens when the pipes that move money fastest get cut off by the people who control them. Let's start with the numbers. Venezuela's government has an estimated $6 to $8 billion in frozen assets across US and European banks. Sanctions dating back to 2019 lock that money away. The government's public plea to access even a fraction for earthquake response has been rejected. Meanwhile, remittances from the Venezuelan diaspora, 5.5 million people scattered across the world, now exceed $4.2 billion annually. Most of that flows through crypto rails because traditional banking corridors have been severed. This is where India's move becomes revealing. The RBI isn't just targeting retail crypto traders; that battle was fought years ago. Instead, it's severing institutional bridges. Banks, insurance companies, NBFCs would all be prohibited from holding crypto assets on their balance sheets, facilitating crypto-backed loans, or offering custody services. The central bank cites systemic risk and dollarization concerns. The language is technical. The impact is political. Here's the pattern that matters: when your government's bank accounts can be frozen by foreign governments, when wire transfers take weeks, when your national currency inflates over 1,000% annually, crypto becomes the least bad option. It's not about getting rich on meme coins. It's about paying for insulin when Western Union stops serving your country. Venezuela proves this. After banking sanctions intensified in 2019 and 2020, crypto adoption surged 2,400%. Binance peer-to-peer Bolivar trading now regularly exceeds official Forex market volume. Local Bitcoin's Caracas trading hit all-time highs during 2023 and 2024. Now consider what India sees. The RBI tracks $22 billion in annual crypto fiat conversion flowing through Indian exchanges. That's down from $48 billion pre-regulation, but still substantial. More concerning for central bankers, an estimated $8 to $12 billion in annual remittances from Gulf states to India now routes through crypto intermediaries to avoid fees and currency controls. That's money bypassing the formal banking system the RBI oversees. From the RBI's perspective, this is leakage. But here's the collision that nobody's talking about. India's crypto ban and Venezuela's frozen funds represent two sides of the same geopolitical currency war. And the humanitarian implications are just starting to surface. 3 specific implications are unfolding right now. First, the sanctions relief stablecoin hypothesis. In multilateral development circles, there's quiet discussion about disaster-earmarked digital currency instruments. The concept is simple. Stablecoins or CBDC-adjacent tools that can be frozen for normal government use but auto-unlock when specific humanitarian triggers occur. An earthquake over magnitude 7.0. A cholera outbreak. A confirmed refugee crisis. The IMF's July 2026 working paper on programmable humanitarian finance sketches this framework. But if India's approach becomes the template, and 12+ other emerging markets are watching the RBI closely, these tools would be dead on arrival. You can't build humanitarian finance infrastructure on rails that banks are legally prohibited from touching. Second, remittance fragmentation accelerates. Venezuela's diaspora sends money home using whatever works. Western Union where available. Crypto P2P because it's cheaper. Physical cash mules because sometimes it's the only option. If India's institutional crypto ban succeeds and gets replicated across BRICS plus nations, we're looking at a bifurcated global remittance system. North-south corridors remain dominated by traditional rails with high fees and high control. South-south and sanction-affected corridors fragment into gray market crypto, hawala networks, and bilateral CBDC experiments. The human cost is $30 to $80 per transaction in lost value through inefficient routing. Across Venezuela alone, that's $150 to $350 million annually that doesn't reach victims. Third, the emergence of sanction-neutral money as a political category. Watch for a new framing in diplomatic discourse. The concept of money that cannot be weaponized. Not crypto specifically, but any financial instrument that maintains humanitarian access regardless of political situation. The Swiss government's June 2026 consultation on neutral digital value transfer hints at this. Singapore's MAS exploration of humanitarian liquidity pools that sit outside correspondent banking. Even the Bank for International Settlements has a working group examining apolitical settlement infrastructure. If Venezuela's earthquake response gets meaningfully delayed due to frozen funds, and it already is, expect Tier 1 humanitarian organizations to openly call for sanction-neutral payment rails by Q4 2026. That puts regulators like the RBI in an uncomfortable position. Maintain financial sovereignty, or facilitate tools that can bypass it for humanitarian purposes? There's no clean answer. Consider the risk scenario. Regulatory fragmentation without humanitarian exception. India bans institutional crypto. The US tightens enforcement. Europe follows. Meanwhile, sanctioned populations and disaster-affected regions have no reliable financial infrastructure, traditional or alternative. The vacuum gets filled by genuinely illicit networks. That's the worst case. But there's an opportunity angle too. This collision could force a mature conversation about tiered financial access. Maybe institutional banks shouldn't hold speculative crypto. But maybe humanitarian remittance corridors and disaster relief mechanisms deserve protected status. A financial equivalent of Red Cross neutrality. Several fintech companies are already positioning for this. The Stellar Development Foundation is quietly building CBDC bridges specifically for remittance corridors between sanctioned and unsanctioned nation pairs. Circle's USDC has humanitarian transaction monitoring that could theoretically auto-release funds based on verified disaster parameters. Here's the 48-hour window that matters. Venezuela's earthquake response has about 48 hours before acute needs, shelter, water, medical supplies, become chronic crises. Disease. Secondary casualties. If frozen funds don't get released, crypto transfers from the diaspora will be the primary source of rapid deployment capital. Just as India moves to cut off institutional pathways. The International Monetary Fund's initial Venezuela disaster assessment estimates $1.2 to $1.8 billion needed for immediate response. The Venezuelan government claims access to maybe $200 to $300 million in accessible reserves. That $1 billion gap? It's being filled right now through ad hoc networks of crypto donations, diaspora transfers, and multilateral aid that takes weeks to deploy. India's crypto ban and Venezuela's frozen funds aren't separate stories. They're the same story about who controls the pipes when money needs to flow fastest. The traditional answer was governments and central banks. But when governments freeze each other's money for political reasons, and central banks ban alternatives for sovereignty reasons, the neutral ground for humanitarian finance simply vanishes. The next 12 months will determine whether the world builds purpose-specific rails that can't be weaponized, or whether disaster relief becomes yet another casualty of currency wars. For the 3,811 families in Venezuela burying loved ones this week, that's not an academic question. Follow Atlas Signal for daily intelligence on these collisions between policy, finance, and human cost.